Hello, left fielders. At LFI, you know our focus is on networking and education. Mark your calendars because we're going to have a full day of it dedicated to you, our limited partners, at the Best Ever Conference on April 9th in Salt Lake City. LFI is opening the BEC with Passive Investing with Left Field Investors, an event focused on passive investors. This will be where insightful content meets passionate limited partners. If you enjoyed BEC last year and the meetup in Left Field this year, then imagine them both back to back. The Best Ever Conference isn't just any event, it's the premier conference for commercial real estate investors and operators. Your ticket to Passive Investing with Left Field Investors includes admission to the entire Best Ever Conference from April 9th through the 12th. Join us April 9th where we will have a packed agenda with sessions focused on how to be a successful limited partner led by experienced LPs, top operators, and partners. Then, immerse yourself in the full Best Ever Conference where you will be surrounded by like-minded investors, operators, and industry experts for unparalleled opportunities for learning and networking. The best part, and there are so many, but the best part, you won't find a bigger discount on a regular ticket price than the one you get for being an infielder. That's more content for an exclusive lower price. Register for the event today at leftfieldinvestors.com/BEC, and we will see you at Passive Investing with Left Field Investors at the BEC. Are you looking for a way to invest at a lower minimum and participate in more deals? Look no further than our weekly deal webinars hosted in collaboration with TribeVest. With every deal we offer, Left Field investors have the option to join an open tribe, allowing you to invest for as little as $10,000. No need to meet the standard $50,000 minimum. Joining an open tribe is easy. TribeVest handles all of the setup, fund collection, and distribution, and even provides K-1s for tax time. All you have to do is sign up. Stay up to date with LFI by subscribing to our emails and gaining Clubhouse access to join our deal webinars and open tribes. Don't miss out.
In my experience, when you give a tenant something that they can be proud of, they tend to take better care of it. If you give them a piece of garbage, a lot of times they're going to treat it like it's a piece of garbage.
Hello, left fielders. Welcome to Passive Investing from Left Field podcast. Our community is focused on networking and education to help people invest passively and think differently. Let's go.
This is Chris Miles, and you are listening to the Passive Investing from Left Field podcast.
I'm really excited to have Ron Lockhart with us. He's the co-founder of GSP REI and serves as one of the company's managing partners. His chief responsibilities include strategic planning and oversight of the company's vision, which we're going to hear a lot more about. He's also one of the co-hosts of the Real Estate Investing on Point podcast, which they just started up. It's just a few episodes in. Ron, welcome to the Passive Investing from Left Field podcast.
Jim, thank you for having me. I really appreciate it.
Well, it's great to have you here. And the first question I always ask is, tell us about your journey. How did you find real estate? How did you get into single-family homes? And then how did you make the decision to scale it up and do kind of a syndication/fund model with the single-family homes?
Sure. I'll try and give you the short version because it's really evolved over a 25-year career in real estate, and I've really touched a lot of the different facets along the way. But the journey started in the late 90s on the construction side of the business. Through a family relationship, I got involved in a construction business, went on to develop my own construction company. We built single-family homes in the suburbs of Philadelphia and down at the New Jersey shore. And what I quickly found was, as much as I liked construction, I didn't really enjoy building houses for other people. So we ventured over to the speculative side of it. We were speccing homes, selling them. And through that, I really got into the investment side of real estate. I was a history major in college, so that really had no real life application to what I was doing outside of, I did like historic architecture. I always found that fascinating. So yeah, we continued to utilize our construction operation as we ventured into the investment space, and over time we started buying more and more. And one thing that I found was we were really structuring our own loans. And I had a broker that I utilized in New York for our finance side or for our deals. And when I realized what he was making on them, I said, wait a second, we're going to set up our own shop in conjunction with what we're doing. And he said, do me a favor, don't do that. Come up to New York and partner with me. So I actually spent 3 days a week in New York doing commercial and residential real estate finance. And I continued doing that in conjunction with the rest of our business through 2008. And, 2008 really forced anybody who was in real estate and really anybody who was in the world to kind of look at things a little bit differently. So we fortunately made it through 2008. We definitely had our lumps and our scars. Continued in running our investment business. We actually started consulting alongside of that and investing along some of the companies that we were consulting with. And fast forward to 2017, we developed a relationship, and this is my short way / long-winded way of getting to the affordable housing. We developed a relationship through a nonprofit that did work with HUD, and they were actually out of Arizona. And we became a qualified development services partner for the National Community Stabilization Trust and the NSI program, where we would get bank-owned assets through the government that would have to be redeveloped, and you had to have one of two successful outcomes. They could be sold to an end user that met certain requirements from an income standpoint and some other factors as well, or you could hold them for a 6-month period, rent them out, and take them over long-term. And we were always the capital partner in this scenario. So we started looking at a lot of the assets that we were taking on, and as we got closer to in 2019, we realized a lot of these made really good rentals. And we started to see that demand increase more and more and more. So we started to shift our focus from more of a disposition model to a buy and hold model. And we were already working in the New Jersey and Philadelphia areas. And we started really taking a good hard look at Baltimore, which has become a big focus of our operation. And we saw a lot of demand down there as well. And, as we explored these markets, we explored the space more and more, we started to realize affordable housing was arguably the biggest real estate problem in the country, or crisis. We have a massive shortage of affordable and workforce housing. And we thought, the way our company is structured, we have construction management in-house, we have property management in-house, we have acquisitions in-house. It really worked for us. I'll be the first to admit it's not sexy what we do, but the returns are very good, and it fits our strengths and our infrastructure.
That's great. That's a great introduction. And I'd like to take a step back and just make sure we're all on the same page here. You talked about affordable housing and workforce housing. Are those the same thing? And can you explain exactly what that means?
Sure. The workforce and affordable housing are a little bit different. Affordable housing is really defined by a potential tenant spending no more than 30% of their gross income on their rent. And in a lot of these metropolitan areas, the rents just are exceeding what 30% of their gross income is. And so the affordable housing, we tie that more to the subsidized housing. So we do a lot of work with Section 8 and other subsidy programs. So that's the tenant that needs a little extra help. They're paying, so in some cases they're not paying any of the rent. It's all coming from the government, or they're paying a portion of it. The workforce housing, it's the tenants that their income is it doesn't quite meet the criteria, but they still need that it's not lower income, but it's lower to middle income housing. So They're very closely related. It's just slightly different in the definition.
And the Section 8, can you talk about that? And, I've heard people say, no matter what, you don't want any Section 8. And I've heard other people say, give me as much Section 8 as you got. And when I was an active real estate investor, I had a few properties that had some Section 8 units, and the nice thing was the rent, you knew you were going to get paid, right? Because the government would take care of that. And the units, usually they were taken better care of because no one wants to lose their Section 8 ticket, right? So can you just talk about the pluses and minuses, or actually first tell us what Section 8 means generally, and then the pluses and minuses of it.
Yeah, sure. So Section 8 is funded from the federal government through HUD. The program was actually originated through a housing act in the 1930s, but Section 8 as we know it has really been around for decades. So it's, we get the question a lot of times, what happens if funding stops for Section 8? I personally, I think that's highly unlikely. It's been around again for decades through different administrations, different political parties in power. And as we continue to see housing become more and more of an issue, I think there's really going to be more and more of a need for it. When you look at Section 8, it's funny, you just said a lot of the things that I've always heard over the years. But we found that we have probably fewer problems with Section 8 tenants than we do with some of our higher end properties that are in a different portion of our legacy portfolio, because we do own stuff that we've owned for years, $600,000, $700,000 homes. And probably from a percentage basis, or from a tenant standpoint, I've had more problems with the higher end than I've had with the lower end. But at the end of the day, I tell people this all the time, whether it's Section 8, middle market, high end, it really all starts with your screening of tenants. And we screen Section 8 tenants no different than we screen non-Section 8 tenants. We want to make sure that their background checks, there are no issues there, no criminal activity, no court cases for past due rents or evictions or anything for that matter. So, the quality of the tenant, whether it's Section 8 or non-Section 8, is just as important to us. And to your point, and this is a big argument that we use, there's a very high demand and a backlog in a lot of these cities for Section 8 vouchers. And if you lose them, you're not getting them back. So there's an incentive for the tenant to take care of the home. If they pay a portion of the rent, to make sure they're paying a portion of the rent. So we really find, and we also find that there's a lot less turnover as well. When a tenant gets in there, they don't want to lose the house. They don't want to move. They want to stay. So our experience with Section 8 has really been positive. And when you're built like we are, we're already managing scattered site single family. So that really just fits in with our model. So I think a lot of the challenges that people have when it comes to whether it be Section 8 or anything else, when you look at any sort of scale, it's, do you have the ability to manage everything?
Right. And I do want to get into that. First, though, I want to talk about the markets you're in, because, when you think about what we do as passive investors, we're mostly investing in all the growth states, the southern states, Arizona, Florida, Texas, and where people are always thinking with the big cities, you got to stay away from the big cities. Don't go to New York, Philadelphia, Baltimore, right? And that's where you are. So that's very intriguing to me. But can you talk about why Philadelphia and Baltimore, and I think you mentioned New Jersey as well, and how you are able to be successful there? Because when I look at cities like that, I've always thought about this. It seems like most of the properties or most of the people living in those cities are renters, yet everyone says, in our kind of little niche of passive investing through syndications, everyone's like, oh, no, you don't ever invest there. So talk about the markets a little bit.
Sure. So probably the primary reason for focusing on those markets, they have to work and they have to make sense from a demand standpoint. There has to be a reason to go there. But secondarily for us, we're located just outside of Philadelphia. And when we invest in something, we want to be able to look, touch, feel. So Baltimore, New Jersey, Philadelphia, they're all accessible to us. We have our own crews there from a construction standpoint, our own people on the asset and property management side of things. And, there've been a lot of articles coming out lately. It's funny you bring this up about why Philadelphia and Baltimore. Like, there's some of the markets that are getting a lot of the attention because there is such high demand. They are seeing rental growth. And one of the things that we've seen in both of those markets, you haven't seen kind of that hockey stick, rental growth or appreciation per se from a property value standpoint, which tells me it's much more stable and there's consistent growth. And that's what I like to see. This wasn't pandemic fueled. Like a lot of markets were pandemic fueled when you saw the appreciation, the growth, and the rents as well. Baltimore last year, I believe the appreciation was like 11%. So, and when we invest in a market, appreciation is certainly not our first metric that we look at because we're buy and hold. We're not looking to sell these properties. We certainly factor it in, but I tend to take the 100-year appreciation rate of 4% per year if you stretch it out over time. And that's what we use when we model. And in our actual model in our growth fund, we actually use 2%. So we're extremely conservative. The way we look at appreciation, we're really looking more at cash flow. But both of those markets, the rent has just been steadily increasing. And that's really tied to the lack of supply and the high demand.
Okay. Well, I'd like to talk about the process and how you find properties, what type of properties. When I was going right out of college, I lived in Philadelphia, and I lived downtown Philadelphia, and they were all row homes, right? I had an apartment row home that was 4 stories, but it was so narrow that when I got a pizza and I wanted to take it downstairs to the kitchen, I had to tilt the box because the stairs were so narrow. So can you talk about, are you buying properties in these downtown areas? And if so, what type of houses they are? How much are they typically worth? What kind of renovations? Just talk us through kind of the process, if you wouldn't mind.
Sure. So we buy primarily row homes in the metropolitan areas. Because of the way we're set up, our ideal property is something that we're purchasing that is a complete renovation, where we're taking it down to the brick walls, we're reframing, new wiring, new plumbing, everything. It's essentially a new home except for the exterior walls. We find that that's one of the best ways for us to create equity in the properties. And our model, our per door model in those markets, specifically Baltimore, it changes a little bit for Philadelphia because Philadelphia is a little bit more expensive, but Baltimore is our big focus at the moment. So I'll use that as an example. We want to buy a home ideally for $10,000 to $20,000. We want to put into that home anywhere from $90,000 to $110,000. And on average, they're appraising for $165,000. And in most cases, they're appraising for more than that. But again, we try to be conservative. So we're creating a lot of equity when we can buy at those numbers and develop at those numbers. And one of the reasons we're able to develop at those numbers is because we do the construction in-house. If we were having to pay a third party, that would certainly change, but that's not the case. I mean, that's one of the strengths of our business. The homes, and I've been in those homes in Philadelphia that you're talking about where, you feel like you could bounce off of either wall. When we take these properties down to the brick walls, we're reconfiguring them. We're making the staircases wide. Everything has to be to code, and a lot of that's changed. So the properties have a different look and feel, and we have a pretty cookie cutter process. We use a lot the same colors, the same tile, but we put quartz or granite countertops in. We put stainless steel appliances in. And, this also ties back to the tenants. In my experience, when you give a tenant something that they can be proud of, they tend to take better care of it. If you give them a piece of garbage, a lot of times they're going to treat it like it's a piece of garbage. So we really, not to say that we don't buy properties that are value add or a property that has an existing tenant that becomes really a pipeline deal for us that eventually we'll go back and renovate. If it's in the right area, if it's on a block that we own a lot of property. So we don't just buy those full renovations. We look at other stuff if strategically it makes sense. But our sweet spot is really getting a property that we can take down to the walls and build it back up.
you said a property costs $10,000 to $20,000 in Philadelphia. So
Baltimore.
Baltimore. Sorry. Still, what does that property look like when you walk in? I mean, I can't imagine it's habitable if it's only. Are these like already boarded up, foreclosed, just empty properties, or are these actual properties that someone was living in before?
He's not living in those. The other properties that I mentioned, like the value add opportunities, where we may buy something for $70,000 that has a legacy tenant in there that the rent's going to be way below market. We'll run out the term of that lease, get the tenant out, then we'll go in and renovate it. I'm saying our sweet spot is that $10,000 to $20,000 acquisition, 100% renovation. I mean, some of those houses that are $10,000 to $20,000, roofs have collapsed, floors have collapsed. It's completely and totally uninhabitable. But that's where we create the most value. We look at it almost like new construction, and that goes back to our roots. And we do buy lots for new construction as well. So the more we can improve the property, the better. And that also helps with deferred maintenance. If you can go in and you're turning over essentially a brand new house, you can have a lot less maintenance problems.
Hi, this is Zach Happenstall, CEO and co-founder of Rise 48 Equity. At Rise 48, we've successfully purchased 38 different properties worth over $1.5 billion worth of real estate and gone full cycle and sold 11 different properties, drastically exceeding projections for our investors. If you're looking to invest with an experienced sponsor in either the Phoenix, Arizona, or Dallas, Texas markets, then we're the group for you. To learn more about investing with us, visit our website at rise48equity.com and set up a call with us. Thank you.
Investing in syndications can be a daunting task. Wiring a large sum of your hard-earned money to someone you talk to on the phone for 30 minutes can certainly be scary. How can you be confident in what you're doing? Steve Sue, one of the founders of LFI, just published a book called Avoiding Rookie Errors as a Left Field Investor. 20 lessons learned from 14 years of investing in private syndications. This is by far the best book I've read on syndication investing. It's an easy-to-read book, chock full of great advice from Steve's experience as a passive investor. It is a must-read. Whether you're a first-time passive investor or a veteran, go to www.leftfieldinvestors.com/books and click on the link to Avoiding Rookie Errors as a Left Field Investor. If you are a passive investor, you got to read this book. So you buy these properties, full rehab, make them nice. They're worth, I think you said 150, 160 grand after you're completed, roughly. What would that rent for in Baltimore?
On the average, $1,600 to $1,650. That's our average rent. So we have some that are higher, $1,750, $1,800. We have some that are a little bit lower, $1,450, $1,550, depending whether it's a 2-bedroom, 3-bedroom, 4-bedroom. We base our entire model when we're looking at acquisitions and we're projecting. Our average, we take an average rent that's actually below our average. We take $1,450, and we take an average after repair value of $165,000. So when we model, we're more conservative.
Right. You're in the ballpark of the 1% rule, which is, as a former person who used to buy single family homes, I was always looking for the rent to be about 1%. The monthly rent to be about 1% of the total purchase price was kind of just if it was close to that, I would look further. So you're close to that, and that's hard to find these days in the popular markets.
Yeah, and again, this, not everybody, we have what I like to think of as a competitive advantage in some markets like Baltimore. Big investors are not looking at this space because, it's harder for them to make the numbers work because they have to rely on so many third parties. And they also have to be able to spend, significant sums of money on acquisition. Like you take an Invitation Homes that, they look to spend over $1 billion a year on acquisitions. Their target is a much different product. It's nationwide. They're about volume. They're obviously publicly traded, but they're not going to go into a city like Baltimore and try and do what we do. It just wouldn't make sense. So we don't have to spend as much money and acquire as many properties to be very profitable.
And do you get any subsidies or help from the state or city governments? I mean, I'm sure they love what you're doing, right? You're taking these blighted properties, you're making them nice, and you're putting in tenants that might not otherwise be able to afford something like that. I know they do Section 8 and things, but are there any other government subsidies that help you out?
So there are things that are available, and right now we're actively looking. They're opportunity zones. So you have to purchase the properties in specific areas. Right now we're vetting out a few new areas that we're going to start buying in to take advantage of some of the tax credits. And in some cases, there's development money there as well.
Yeah, that's great. And then the property management. So one of the things that's difficult about single family homes and scaling is, they're not all right there. Like if you had 100 units and it's a multifamily property, you're right there all the time, right? Everything is done. But if it's 100 properties spread throughout Baltimore, I'm sure you're trying to concentrate things. But can you talk about how the property management works, especially when you're talking about these single family homes that aren't always just all lined up on the same street?
Sure. And it goes back to how we're built and how we're structured. We have at our home office in Pennsylvania, we have our head of property management. And then in whatever market we're located in, we have another head of property management for that market. That person oversees all the property management there. We have agents that we work with for leasing, that we have a multi-tiered vetting system. The agent vets it first, the market property manager vets it next, and then we vet it at the home office. Because we have our own crews, construction crews, they also function as our maintenance crews. So at any given time, we always have somebody available on call to handle maintenance requests. So for us, that's not really a big challenge. A lot of times we get that comparison between multifamily and single family. I can make arguments for and against both when it comes to the property management side. A large multifamily complex, also has the grounds to think of. Sometimes in a multifamily building, if one thing goes wrong, it can affect the rest of the building. But on the flip side, for single family, to your point, it's scattered site. So it can be a little more labor intensive, but we don't find that adds additional cost to our operation. And again, when you target the type of properties that we're targeting and you're turning over a new product, you get a lot, there are much fewer maintenance requests than, if you're just kind of, pardon the expression, you put lipstick on a pig. Those are the properties that you have a lot of problems with. So again, I think a lot of it, you kind of reap what you sow when you turn a product over.
Right. And can you talk about, there's shared walls, right? These are row homes, so shared walls, shared roofs with neighbor properties that you may or may not own. Does that factor in? Are there concerns or are there things that you have to figure out because you're sharing a roof and walls with other owners?
Yeah, so when we purchase a property and we do renovations, the big thing you're going to look for is in the basements and the roofs. Is there a problem with the adjoining property that may cause a problem? And as long as we're protecting our property, like I'm going to use a roof, for example, from day one, we can mitigate any issues that the neighbor may have with their roof if our roof is properly repaired or constructed. In the majority of the houses that we're working on in the cities, we put sump pumps in. So if there's a water issue with the neighbor, it's not going to affect us. So those are the two areas where you look for potential problems, and we look to mitigate that right from the beginning. A loud or obnoxious neighbor, you can't quite control that, but you can get that in $1 million neighborhood. So
that's true.
Certain things are beyond your control.
That's true. And what about debt? Are you using debt on these properties? And do you, once you finish the construction, do you refinance or do you have pooled debt for all of them together? Can you just kind of talk about any leverage that might be available?
Sure. So we fund this through a number of different avenues. We use our own capital. We have 2 different funds where we utilize capital from both funds depending upon the structure. We also have 2 $15 million lines of credit that we can utilize as bridge capital. So it could be acquisition and construction finance. It can be utilized as a delayed finance, that if we have a number of projects moving forward that we funded with cash, we can go ahead and do a delayed finance deal there. And our exit is always portfolio loans. So we put permanent refinances on all these properties. Once we hit, we like to use non-recourse loans. So they have minimum loan amounts. The one lender we use on a regular basis, the minimum loan amount is $2.5 million. But when we do larger refinances, it helps us with the interest rate. So we tend to try and target more like $5 million in a refinance. Everybody with the interest rates over the last 6 or 8 months, has been dealing with that. And so we try to get as creative as we possibly can. Where in the past we would, on the permanent financing, we would use 30-year AM mortgages almost exclusively. Sometimes now we'll use a 10-year loan with a 30-year AM, and a balloon after 10 years. It brings the interest rate down. So we're constantly watching the interest rate environment, what products are out there, and and how we can use those to the best of our ability and fits our model at the best. I came up in the late 90s. This interest rate environment to me is quite frankly, it's more normal. I think the last 10 years we've had interest rates that have allowed investments to be successful that in the past would not have been successful. And I think that's really changing now. And I think that's something that people are going to have to look forward with. You got to really see the forest through the trees now. When we model our acquisitions and our portfolio, we already stress our rates up over 8. So when we saw this increase, it really wasn't impacting how our model functioned. Does it cut into your profit? Absolutely. But our model is still very profitable, even with interest rates where they are. Our current non-recourse loan we're working on right now is still in the high 6s. So, we're pretty comfortable where we are at the moment. Would I like to see lower interest rates? Sure. But I'm certainly not counting on it. We can't model like that.
And, our community is full of passive investors, limited partner investors who invest in syndications and funds. Can you talk about, how does this affect LP investors? Meaning, we're used to investing in a multifamily property or a fund of multifamily, and this is very different. So how do we vet the operator, which is your company? If you were investing in as an LP, how do you make sure that, okay, this is the right company to invest with? And then how do we analyze the fund? Because usually we're looking at individual properties or a group of individual properties, and we're not going to go in and analyze each different home that you own inside the fund. So can you just talk about, from an LP perspective, what we should be looking at, what kind of questions should be asked?
Sure. First and foremost, with any investment, everything can look great on paper. And, the numbers can look fantastic. At the end of the day, everything boils down to execution. So, taking a look at our operation, having conversations with us, looking at any information we have on our portfolio, would help give you an idea of whether you think we can execute or not. At the end of the day, I can tell you whatever I think somebody wants to hear, but that's not going to get you to trusting that person or wanting to take a chance to invest with them. I think you got to take a good hard look and have a lot of conversations with them about how they're structured, how they operate. With us, unlike, a multifamily syndication, which tends to have a defined timeline, defined exit, we're obviously investing in a lot of different properties. And for that reason, we have our historical data that our model is really built around. So people can ask us specific questions, property level, how did you come to these numbers? And that's something that we can share, that, this isn't just pie in the sky. We didn't just run numbers on a market and put together projections, we did this based off of our historical numbers. And I don't go back 5 years. I like to look at it in 24-month clips because markets change. If you take into consideration, the pandemic years, that skews things. So, I encourage people to look, trailing 12, trailing 24 to get a better idea of really how that market's moving. And especially since interest rates have had more of an impact over the last 12 months. So that's where I would start, and those are the questions I would ask. But at the end of the day, again, I think it all boils down to execution, and I think you have to believe that the people you're investing with have the ability to execute.
Right. That's a great point. And then you mentioned you have two different funds. Can you talk about each fund, what they do, what the purpose is, and then also what's the exit for the LP? I know you said you don't plan to sell any of these properties, but at some point, your LPs might like their capital back. So what are the options there, and what is the typical cash flow? Just kind of give us an overview of the funds.
Yeah, so the first fund, the income fund, and this is our third income fund. We've already had two that have closed. That functions just like it's a preferred payment. It's structured more like debt. So it has 1-year terms, 3-year terms, 5-year terms, and accompanying interest rates all the way up to 12%. And so, your term's up, your capital comes back. Our other fund, the growth fund, we had a lot of our investors over the years who have been in our income funds ask us how they could share in the upside. They wanted tax benefits. They wanted to benefit from the appreciation. They wanted to benefit from the cash flow. So we developed the growth fund this year, which we launched in May, where our limited partners share in 50% of the equity growth and 50% of the cash or the profits. But it also pays a 6% pref along the way. So that's more, I know it feels a little bit like a syndication, but it's not really a syndication. It's a 5 to 7 year term. We do allow requests for redemption after 3 years. So if people want to get out early, they can. We've had a really good response to that fund because it's a little bit different than what you're seeing out there right now. And the way we exit is through refinances. When somebody, and that's built into our model, if somebody in year 5 says they want to exit, we do that through refinances. I believe over 7 years, the average annual return is about 22%. It's got over a 3 times equity multiple after 3 years. And again, that's all built off of our historical data.
Okay, excellent. And is this for accredited investors only?
It is, yes.
Okay, awesome. Well, this sounds really interesting. The last question I always ask is, what is a great podcast that you listen to? You cannot say the Real Estate Investing on Point podcast because that's your podcast. So do you have another one that you'd like to listen to?
Yeah, I do. I like the Real Estate Syndication show. I enjoy that one. And, now that we've been on this one, I'm going to certainly be listening to this one as well. So I think I mentioned to you before we got started, podcasts are kind of a new thing for me. But
yeah,
I get in touch with them and listen to ones other than our own because I can't quite get myself to listen to the ones that we do because it's a little awkward listening to myself talk.
Yes, I get that.
But I am starting to enjoy them more and more because there's a lot of good information out there.
Yeah, and being the host, you get all the good stuff because you can ask all the questions. And it's funny you mentioned the Real Estate Syndication show, and I don't know if this is breaking news or not, but I'm going to be guest hosting on that one moving forward. So you named the 2 podcasts I like the best also, so I appreciate that.
There you go.
Yeah. And if listeners want to get in touch with you, learn more about GSP REI, what's the best way they can do that?
If you go to the website, gsprei.com, our primary contact for any sort of investor questions or any other questions is Peter Neal. And you can find his information on the website. So gsprei.com, Peter Neal.
Awesome. Well, thank you very much for being on the show. It's fantastic, and I learned a lot. I appreciate it.
All right. Thank you so much for having me, Jim. I appreciate it.
Thank you. Visor provides investors with a secure platform that displays a comprehensive view of all of their holdings on a single, holistic dashboard. From real estate syndications to private equity, crypto to traditional investments, with AI-driven, unbiased, honest insights to maximize return. Visor is your one place to rule them all. Automating performance tracking, projecting future cash flow, analyzing all your financial documents, and much more in one powerful solution, making it easy to follow the money. Sign up for a free 30-day trial now at Visor.co. That was a great conversation with Ron. Just really interesting because it's something, that we're all familiar with, right? Single family homes. Most of us have lived in one at some point in time or another. And talking about affordable housing in the East Coast. So I just was really interested in it. Ron talked about affordable housing being the biggest problem in real estate, and it's true in so many places. You have big cities that people can't afford to live there anymore. So providing affordable housing is critical. And then you have other smaller towns, vacation towns, and things like that are also having issues. And it's just a big problem. To find somebody solving it in a unique way is fascinating to me. And, I used to own a bunch of single family homes. And one thing he mentioned was tenant screening is critical. And he has a multi-pronged process to screen tenants. And I think that is the most important thing. I love that he does Section 8 because, as he said, no one wants to lose that voucher, and that changes the behaviors. And then you throw on top of that they're really doing effective screening of their tenants, and that's the biggest thing, right? You want to reduce move-outs, and if people do move out, you want to make sure that they're not trashing the place and causing you a whole bunch of repairs that have to happen. So tenant screening is critical. And doing the total rehab of the home, that is also critical, I think, because if you do the total rehab, all the mechanicals, everything is going to be set up, and you're going to have a lot fewer repairs. When I was buying single family homes, you had to do the bare minimum, right? Because you had to make it work in your economics. And so sometimes you would have some of these repairs that you weren't expecting because maybe the person who was doing the rehab for you didn't do the full rehab or didn't do all the things that were necessary. So I like that they're doing that, and they do it. He said cookie cutter process, right? So that means that they're putting the same stuff, the same paints, the same flooring, the same everything for all their houses. So all the contractors they're using know exactly what goes where, and that just makes for efficiencies. But the thing I like the most about this asset class is that they found a niche, right? They are in a market that there's probably not a whole lot of competition for buying these $10,000 or even $70,000 homes because they are so intensive to rehab, and they've got a really nice niche in the markets. Everyone's plowing money into the Smile states and the South and all these places that we are all investing. So when I see something like this, it immediately I think, okay, diversification, right? I can get asset class diversification, I can get market diversification, I can get operator diversification, and I really have a lot of diversification opportunities here because it's not something that we typically do. Now, that also means the due diligence really has to be there because it's also not something I'm familiar with, the way they're bundling everything together. But again, I am familiar with single-family homes, so it's a very intriguing asset class. And I really regret the one question I didn't think to ask him until after we stopped recording, and then I asked him was, he's a Philly guy, so what is your favorite cheesesteak? And he said Jim's, which is on South Street, which I used to live off of South Street, so I am a fan of Jim's, but I was a little bit disappointed that he didn't say Tony Luke's, which is my favorite, but he did say they are all awesome, and on that, we are in agreement. So really enjoyed Ron on the show. Thank you all for listening. That's all we have for this time. We'll catch you next time in the left field. Thanks for hanging out in the left field with us today. If you are interested in becoming a left fielder, you can find us on the World Wide Web at www.leftfieldinvestor.com and click the subscribe button to join our community. If you enjoyed the podcast, please subscribe to the show on your podcast player so you don't miss an episode. If you really enjoyed the show, a review on Apple Podcasts or wherever you listen to podcasts would be appreciated.
This show is for entertainment purposes only. Nothing said on the show should be considered financial advice. Before making any decisions, consult a professional. This show is copyrighted by Passive Investing from Left Field and Left Field Investors. Written permissions must be granted before syndication or rebroadcasting.